All right, so you've sent us a really interesting bunch of articles. They all seem to be focusing on one big question. Could we see a stock market crash in 2025? Now, we're not claiming to be fortune tellers here, and predicting the future with certainty is impossible. But what we can do is go through these articles, pull out the really important insights, and help you understand the risks everyone's talking about, the different viewpoints on how likely they are, and most importantly, how you can navigate all this uncertainty without feeling completely lost. We've got articles looking at potential economic shocks, investment strategies, the whole 9 yards. So let's dive right in.
Yeah, and looking at these articles, the first thing that jumps out is this widespread feeling of caution about the stock market, especially as we look ahead to 2025. It's not just a few isolated voices. There's a definite sense from these sources that a lot of analysts and investors are worried about a pretty big market correction.
Yeah, definitely. And when we dig into the reasons behind this unease, there's a whole tangle of interconnected risk that keep popping up. I guess the one that's been top of mind for everyone lately is interest rates and inflation. The Fed's been on this path of aggressively raising interest rates to try and get inflation under control, which is something a lot of these articles emphasize. But, as they point out, this has consequences. Higher borrowing costs can really put a damper on spending for both consumers and businesses. And if inflation sticks around longer than expected, there could be even more rate hikes, which creates what they call a bearish environment for stocks, meaning basically a market where prices are expected to go down.
Exactly. And those higher interest rates mean companies have to pay more to fund their operations, to expand, which obviously impacts their profits. At the same time, consumers are also hit with higher costs for mortgages, car loans, all kinds of debt. So they have less money left over to spend on other things.
Hmm.
And if this leads to lower corporate earnings, which in this kind of scenario seems likely, then stock valuations, which are often based on expectations of future earnings, well, those could take a hit too.
Right, right. And these concerns go beyond just what's happening in the U.S. I mean, globally, there's a lot of geopolitical instability. The conflicts in Europe, the Middle East, and Asia, those aren't just far-off headlines. They can actually disrupt global supply chains, which drives up energy prices. It just makes investors nervous overall. And then you add in things like the constant threat of cyber attacks, trade disputes, and political uncertainty in general, and it creates this really complex picture.
And what's really interesting here is how these global tensions can sort of amplify the economic pressures we're already feeling. For instance, when supply chains get disrupted, that can make inflation even worse because goods become scarcer. And when energy costs rise, well, that impacts everything. It squeezes corporate profits even more, and consumers have to pay more too.
Right. And then there's the whole issue of a possible economic slowdown, maybe even a recession in 2025. Several of these articles bring that up. The concern is that a recession could mean job losses, less consumer demand, and ultimately a negative impact on stock prices. One article even points to warnings from big companies like Delta and United Airlines and mentions how consumers are already showing signs of financial strain, like at places like Target and Dollar General. They see that as a possible early warning sign.
Yeah, those are very real-world examples of how a slowing economy affects things. When airlines are expecting people to travel less and discount stores are seeing people cut back on spending, it does suggest that the economy is shrinking. And historically, stock markets don't do well during those times.
And if we're talking about how companies are doing, there's a real worry about corporate earnings. After a period of pretty strong growth, a lot of companies are now running into problems like rising labor costs, those supply chain issues we talked about, and it's harder to get credit. So if their earnings in 2025 don't meet the high expectations that are already built into stock prices, we could see a lot of people selling off their stocks.
One article points out that even a small disappointment in earnings could trigger a pretty sharp market correction, especially considering how high some of these valuations are already.
Yeah, that's an important point. Because the market's at such high valuations now, it kind of suggests that investors are expecting really strong earnings to continue. So any sign that those expectations aren't going to be met, that could cause a lot of investors to rethink how attractive those stocks are, and that could quickly push prices down.
And that, of course, brings us to the idea that the stock market itself might just be overvalued right now. We've seen some record highs lately, and when you look at things like price-to-earnings ratios, a lot of stocks are trading way above their historical averages. So the argument is that a correction might just be overdue. Like, investors might just need to adjust their expectations, and those valuations need to come back down to earth to be more in line with how companies are actually performing.
Yeah, it's almost like a rubber band that's been stretched too far. The more it's stretched, and in this case, that stretching is the high valuations, the more likely it is to snap back, meaning a market correction. When investors start to feel like prices have gone up too much, too quickly compared to how much companies are actually earning or what the overall economic outlook is, that's when they start to get more inclined to sell.
And we can't forget about all the market volatility we've seen lately, those huge swings up and down. That kind of makes investors nervous. So if that volatility keeps going into 2025, it definitely creates an environment where a crash becomes more likely. It's like investors are on edge, worried about these sudden, unpredictable changes in the market.
And those big swings are really a reflection of all the uncertainty in the market. You have investors who disagree about where the market's going, and that makes everyone really sensitive to any news or events that come up. So one piece of news can cause a big shift in how investors feel, and that's what can lead to those rapid price drops.
Now, here's something interesting that one of the articles pointed out. A specific risk in the technology sector. Tech has been a huge driver of market growth, but there are worries about a possible bubble forming in some of those high-growth tech stocks. Basically, the concern is that their valuations might have gotten ahead of how well they're actually doing financially and whether their business models are sustainable in the long term. And because these companies make up such a big part of the major stock indexes, if the tech sector takes a big hit, it could drag down the entire market.
Yeah, the tech sector has always been exciting because of how fast things change and all the innovation, but that also means it's hard to know what things are really worth. It's easy for valuations to get disconnected from what companies are actually earning. And if investors start questioning whether certain business models can actually work in the long run, or if there are new regulations coming that could hurt these companies, then we could see a big drop in tech stock prices, and that would definitely affect the rest of the market.
Another big thing to consider is the rising level of global debt. A lot of countries and companies have taken on a lot of debt, and when interest rates go up, it gets harder to pay that debt back. So if we have a debt crisis in 2025, where countries or companies start defaulting on their loans, that could be a huge shock to the financial system, and it would definitely hurt the stock market. Widespread defaults could lead to a lack of confidence, and investors would start pulling their money out of risky assets and putting it into things that are considered safer.
Right. It's all connected, the global financial system. So a debt crisis in one place, even if it's just one big company, can spread really quickly and create a domino effect. When someone defaults on a loan, the lenders lose money, and then they have to be more careful about lending to other people, and that just makes things even harder for everyone, and the whole economy can suffer.
And last but not least, we have to think about the psychology of the market. The way investors feel, whether they're confident or scared, can have a huge impact. If everyone starts getting really worried about all these risks we've been talking about, they might start selling off their stocks. And all that selling can actually cause the market to go down even faster. Sometimes it's like a self-fulfilling prophecy.
Yeah, the psychology of the market is powerful. If enough people believe that a crash is coming and they start acting on that belief by selling their investments, well, they can actually make the crash happen.
Okay, so we've talked about a lot of potential concerns. Now let's zoom in on some specific signs of economic weakness and why there's a higher risk of recession in 2025. One article focuses specifically on the U.S. economy, and it points to a couple of things. One is the fact that job openings have shrunk considerably, like almost 40% over the past couple of years, including a 10% drop just in the last year. And at the same time, more people are filing continuing unemployment claims, which means they're having trouble finding new jobs after they lose their old one.
Right. And when you see fewer jobs available and more people struggling to find work, it's a pretty clear sign that the job market is losing steam. And a weak job market is a bad sign for the overall economy.
Yeah, and the article also talks about how cutting government spending and slowing down immigration could further hurt the economy.
Yeah.
It mentioned that we've seen a big drop in border encounters, and that could mean slower job growth, less spending by consumers, less demand for housing, and slower retail sales overall.
Those are all important pieces of the puzzle. Government spending can really boost the economy, and immigration patterns affect the size of the labor force and how fast the population grows, which has an impact on how much people are buying and how much demand there is for housing.
And then there's the housing market, which seems to be cooling down quite a bit. We're seeing fewer pending home sales, and a lot of potential buyers are hesitating because prices are so high and mortgage rates are up. A lot of them are saying they won't buy unless prices or rates come down significantly.
The housing market is a big deal for the U.S. economy. So when sales slow down and there's less construction, it affects all kinds of related industries, like companies that supply building materials or provide real estate services. And often, a slowdown in housing is a sign that a broader economic downturn is on the way.
And consumers are definitely feeling the pinch. Savings rates have dropped to record lows, and retail sales are starting to decline. So it looks like people don't have as much of a financial cushion as they used to, which makes them more vulnerable if the economy takes a hit. And that means they probably won't be spending as much in the future.
That's what happens when inflation eats away at people's purchasing power. And for many, their wages haven't kept up. When people don't have savings, it's harder for them to deal with unexpected costs or keep spending at the same level if they're worried about the economy.
Right. And the article brings up that worry about overvaluation again, this time in both the stock market and the housing market. It points to these high ratios of equity to GDP and price to rent as signs that there might be bubbles that are ready to burst, maybe because of all the low interest rates we had for so long and all the government intervention in the economy. It even mentions that prediction markets, like Poly Market, are showing that the odds of a downturn are increasing.
Yeah, those valuation metrics are what economists and analysts use to see if asset prices make sense compared to the actual economy. And historically, when those ratios get really high, it often means a market correction is coming. And those prediction markets, they can give you a real-time sense of how people are feeling, like what the collective wisdom is about the likelihood of certain economic events.
So with all these warning signs, it's easy to feel a bit gloomy, right? But it's important to remember that experts don't always agree, and there are different perspectives out there. Some analysts are actually pretty optimistic about 2025. They point to things like the fact that unemployment is still relatively low, consumer spending is still growing, which I know seems a bit contradictory to some of the things we discussed earlier, but that just shows how uncertain things are. And in certain sectors, corporate earnings are still pretty strong.
Right. It's important to look at the whole picture and remember that the economic data can be mixed. Some things might look bad, but others, like a strong job market and people still spending money, can help support the economy.
One article even suggests that some of those recent drops in the market might just be a kind of overreaction to the really high levels we saw before, or maybe it's just because of uncertainty about things like tariffs and trade policy. And then there was this one theory in one of the articles that I found really interesting, but it's definitely more speculative. It suggests that maybe some of these potential market downturns could be, I don't know, maybe influenced in some way to push for lower interest rates again, maybe as a way to deal with the national debt. It's important to say, though, that this was presented as more of a theory, not something that everyone agrees with.
Yeah, it's always good to be able to tell the difference between what most economists think and what are just kind of out there theories. The way people feel about the market and what the government does are definitely connected, but it's hard to say for sure that anyone is deliberately trying to manipulate the market.
Right. And on a more positive note, one of the articles actually suggested that the market could have a really strong rally in the second half of 2025. The idea is that companies will adapt to the current economic situation, and some of the pressures we've talked about might start to ease up.
That's the thing about markets and businesses in general. They're always changing. When companies have to deal with a changing economy, they can adjust their strategies, and sometimes that can lead to better performance, and then investors get more confident and stock prices go up.
So if all this talk about uncertainty is making you feel a little uneasy, what can you actually do about it? One of the articles had a section called How to Prepare, and the advice was actually pretty straightforward. The first thing they stressed was diversification, which is basically the old saying about not putting all your eggs in one basket. You want to spread your investments across different types of assets like stocks, bonds, even things like commodities.
Yeah, diversification is like the cornerstone of managing risk. You don't want to have all your money in one place because if that one area does badly, you lose a lot. But if you spread your money across different types of investments, things that don't all move in the same direction at the same time, then even if one part of your portfolio takes a hit, the other parts can help cushion the blow.
Another thing they recommended was building up your cash reserves. Having cash on hand gives you a safety net if the market takes a downturn. And it also means you're ready to buy assets at a lower price if there's a big drop.
Exactly. Having cash gives you flexibility, especially when things are uncertain. It can help you get through unexpected expenses, and it means you're ready to take advantage of investment opportunities that might come up when the market corrects.
Right. And the article also said it's important to focus on quality when you're investing. That means putting your money into companies that have strong financials, that are earning money consistently and that don't have a ton of debt. Those are the kinds of companies that tend to do better when the economy isn't doing so well.
It makes sense to invest in companies that are fundamentally sound, right? They're less risky. If they have a good balance sheet and they're making a profit consistently, they're in a better position to ride out any economic storms.
They also mentioned, but just briefly, using risk management tools like stop-loss orders and options. These are ways to try to limit how much you can lose on an investment.
Yeah, those are more advanced investing strategies. They can offer some protection if the market goes down, but they can also be complicated and have their own risks. It's important to understand how they work before you use them.
And then the last piece of advice was to stay informed, like keep up with the economic news, what the government's doing, and how the companies you're invested in are performing. The more you know, the better you'll be able to spot risks and opportunities.
Absolutely. Learning and staying up to date is so important for making good investment decisions. You need to be able to adjust your strategy as things change.
Okay, so beyond just preparing for the worst-case scenario, one of the articles talked about how you might actually benefit from the chaos. One thing they suggested was that a market downturn could be a good time for long-term investors to buy stocks at a lower price. They mentioned how people who invested during the 2008 financial crisis ended up making a lot of money. But, of course, what happened in the past doesn't guarantee what's going to happen in the future.
That's true. When the market drops, it can be a good time to buy good assets at a discount. But you have to be thinking long term, and you need to know how much risk you're comfortable with.
The article also emphasized the importance of staying disciplined and thinking long term. Like, don't panic and sell everything if the market goes down. They also talked about dollar cost averaging, which is where you invest a set amount of money at regular intervals no matter what the market is doing. And they brought up diversification again and mentioned that dividend-paying stocks can be a good option because they give you some income even if the market isn't doing well.
Yeah, dollar cost averaging is a good way to avoid putting all your money in at the wrong time. And when you invest consistently over time, it helps to smooth out the ups and downs. And dividend-paying stocks can give you some stability and income, especially when things are volatile.
Yeah, one of the articles shifted gears a bit and offered some general advice on building wealth, which is relevant whether the market crashes or not. The first step they recommended was pretty basic, but it's important. Make a list of all your assets and all your debts so you have a clear picture of your net worth.
Yeah, you have to know where you stand financially before you can make a plan. That's the starting point for any good financial planning.
Then they talked about making a realistic spending plan, which is basically tracking your expenses, seeing where your money is going, and finding ways to cut back on things you don't really need.
Budgeting and tracking your expenses are so important if you want to get control of your money and have more to save and invest.
They also recommended automating your savings and investments. That means setting up automatic transfers so you're putting money aside consistently without having to think about it every time.
Automating is a great way to take the emotion out of it and make sure you're making progress towards your goals without having to constantly make decisions.
And if your employer offers a 401k match, they said to contribute at least enough to get the full match. They called it free money, which it basically is. And it's a really good way to invest. And they said to max out contributions to your 401k and IRA if you can.
Definitely. Taking advantage of employer matching is like step one for retirement savings.
For people who want a simple way to diversify, they suggested target date funds, which automatically adjust their asset allocation as you get closer to retirement.
Yeah, target date funds are nice because they take care of that risk adjustment for you as you get older.
And lastly, they suggested looking for ways to boost your income so you have more money to invest, whether it's negotiating a raise at your current job or finding a side hustle.
More income means you have more resources to put toward your goals, including investments.
Now, there was one article that made a really interesting point about the difference between investing and speculating. They said that trying to get rich quick by trading individual stocks or putting money into really volatile assets, that's more like gambling than investing. They were really advocating for a long-term approach focused on diversified funds like S&P 500 index funds or ETFs. And they said that if you do want to speculate, to keep it to a very small part of your portfolio, like maybe 5% at most.
Yeah, that's a super important distinction. When you invest, you're taking a strategic long-term approach and you're doing your research and you're diversifying. When you speculate, you're basically betting on short-term price movements, and it's much riskier. And usually it's based on trends and hype rather than the actual value of what you're buying.
And then that same article laid out some key investment principles that are especially relevant right now. One was to chase exposure, not returns, which means you should understand what you're actually investing in, not just focus on how much money you think you'll make. Another principle was to embrace average returns. They said that low-cost index funds are actually a very effective way to grow your money over the long term, and that trying to time the market to buy low and sell high is really hard to do consistently.
Those are some great foundational principles for building a solid investment portfolio.
They also said to think of alternative investments, like crypto, as a side bet. They talked about diversifying over time with dollar cost averaging, which we talked about earlier. And they emphasized the importance of using tax-advantaged accounts like IRAs and 401k, keeping your investment costs low, and understanding that time is money, meaning that patience and the power of compounding are key. And lastly, they said to keep your investment strategy simple and straightforward.
Yeah, simplicity and consistency are often the keys to success in the long run.
The author of that article even shared their personal approach, which is investing a fixed amount every month into a global index fund. They said they don't worry about short-term ups and downs in the market, and they actually see market downturns as opportunities to buy more at a lower price. I actually really like that approach.
It's a very disciplined and unemotional way to approach investing, which often leads to better results in the long run.
Finally, let's touch on the psychological side of dealing with market uncertainty. It's tempting to get caught up in predictions, but as one of the articles pointed out, even though we like to think we can predict the future, it's really hard to do accurately. It's so important to know yourself, to know how much risk you're comfortable with, and to avoid making rash decisions based on your emotions, especially when the market is going up and down a lot. You also have to be able to adapt your strategy as things change.
Absolutely. Managing your emotions is a crucial skill for any investor. It's easy to get caught up in the fear and greed of the market, but if you can stay calm and stick to your plan, you'll be much better off in the long run.
Okay, so to sum it all up, the articles you shared definitely highlight some real risks and things to be aware of as we head into 2025, but it's important to remember that a big market crash isn't a certainty, and experts have different opinions about how likely it is. The economy is complex, with lots of moving parts, so it's really hard to predict what's going to happen with any kind of precision.
Yeah, it's like trying to predict the weather months in advance. There are so many factors involved and they're constantly changing.
Right, but the strategies we talked about today, things like diversification, staying invested for the long term, and staying informed, those are all good practices no matter what the market is doing, not just if there's a crash.
I agree. Those are fundamental principles of smart financial management. They can help you build a portfolio that can withstand whatever the market throws at you.
So I encourage you, the listener, to really think about your own situation. How much risk can you handle? What are your long-term goals? And use the information we've discussed today to figure out what makes sense for you.
Everyone's situation is different, so it's important to find an investment strategy that works for you, that aligns with your goals and your risk tolerance.
And here's one last thought. Maybe instead of trying to predict or avoid a market crash, the best thing to do is focus on building a strong financial foundation that can handle any economic challenges that come your way. Maybe taking a closer look at your own financial plan and learning more about long-term investing strategies would be a really good next step.
That's a great point. It's about being prepared, not just for the worst case scenario, but for anything that might happen.
It's time to fly, a financial journey, we're aiming high. Cashless compass, showing the way to a debt-free life, starting today. No more stress, no more strain. Family, friends, we're breaking the chain. Chasing freedom, we're on the rise. Financial peace, let's reach the skies. Cashless compass, lead me to the top. Debt-free dreams will never stop. You're feeling so free. It's happiness now for you and me. Investments that matter, so worthy of time. Building wealth, yeah, we're climbing high. Education's the key, unlock the door to a stress-free life and so much more. No more limits, no more fear. We're breaking through, the future's clear. Passive tips, income streams. This is the life, we're living the dream. Cashless compass, lead me to the top. Debt-free You're feeling so free. It's happiness now for you and me. Step by step, we're moving ahead. No more chains, no more debts. Building wealth, stress-free, no doubt. Cashless compass, we're breaking it. Cashless compass, leading you to the top. Debt-free dreams will never stop. Passive income flowing, you're feeling so free. It's happiness now for you and me. No mess, no stress, just pure success. Join the journey, we're here to impress. Cashless compass, you're finally free. A life of wealth and serenity. No more stress, no more mess. Family, friends, come and progress. Striving for freedom, we're on the move. Come along, let's start this ride. A financial journey, we're walking with pride. Cashless compass, you're finally free. A life of wealth and serenity, so bright. Woo, woo. No more stress, no more mess. Family, friends, come and progress. Striving for freedom, we're on the move. Come along, let's start this ride. A financial journey, we're walking with pride. Cashless compass, guiding you right to a debt-free life, shining so bright.